Morning, everyone. My name's Jeffrey Yu. I'm the FX strategist covering G10 currencies at UBS in London. I do keep a side eye on China now and then, and it's become an increasingly important part of my job. So we have a distinguished panel here. Ed, you've already heard from already. Just to reintroduce him, he's head of financial sector policy, global markets, and RMB internationalization at HSBC. To his left, we have Dr. Jinke Yu, who is a lecturer, assistant professor at the London School of Economics. So field of expertise is in international macroeconomics, and her research involves looking at why capital flows from developing countries to developed economies. And another one of her studies examines the impact of global demographic differences across countries on asset prices. I think this will be an increasingly important topic for China's policymakers up ahead. So Dr. Jin is from Beijing, China, and holds a BA, MA, and PhD from Harvard University. And to her left is very distinguished client of UBS's, and perhaps of many of you as well, Mr. Stephen Jen. He's managing partner of SLJ Macro Partners, formerly of Morgan Stanley. He was global head of FX research. And prior to that, he spent 4 years as an economist with the IMF in DC, covering economies in Eastern Europe and Asia. And Stephen holds a PhD in economics from Massachusetts Institute of Technology, and also a BSc from UC Irvine. And I'm very happy I'm moderating today rather than coming up against you on a panel. Right, and finally to his left, we have Mr. Zhang Yi, who is a partner at King Woods Mallesons. So he is part of the firm specializing in private equity, mergers, acquisitions, and he hopefully can present a very interesting political angle for us today, as he is a member of the All China Youth Federation and member of the Shanghai Committee of the China's People's Political Consultative Conference. Mr. Zhang holds an LLB from University of International Business and Economics and an LLM from Stanford Law School and an MBA. Okay, so let's start. Now, the topic of today's discussion, and just to continue from the discussion we've had on CNY internationalization, is financial market liberalization as an engine for future growth and lessons from the West. So I'd like to ask all our panelists first, how would you define financial liberalization? So in what form, from your own individual backgrounds, would you see a liberalized financial sector in China take?
Thank you. I mean, I probably heard people have heard enough from me, but briefly, I think opening up the bond markets to offshore issuers and investors, that would be a key and important step. Obviously, we mentioned convertibility, but more channels for moving money on and offshore would also be an important step. And I think there are other areas in which potentially China and other countries could work together. Macroeconomic policy coordination might be one of them.
Well, financial globalization or liberalization takes many different forms. Even in terms of exchange rate convertibility, there are about 20 different levels of exchange rate convertibility, or even more. So it's all about the extent. But I think in terms of China, what China has been experiencing is it allows for capital inflows, mostly in the form of long-term investments, FDI. It has very little portfolio flows, bonds and equities. So I think that's one area to expand on. So I think the different kinds of asset classes would be kind of a form of more financial globalization, but we also have learned from the history of emerging markets like Latin American countries, which have been more globalized financially than trade on a relative basis, and it's the opposite for China, that the kind of risks involved, apart from the benefits, is sudden stop problems and really volatile capital inflows. So is China ready to, is it ready to be able to handle these large sudden stop problems, capital inflows? I personally think it is, because it doesn't have the latent problems that Latin American countries have. It also has a large, current account surplus and saving, so it doesn't really need to rely a lot on net external borrowing. Lastly, I would just say that if you look at the data between emerging markets and advanced economies, one thing that you recognize is that the financial asset trade, in terms of gross flows, gross asset and gross liabilities, among industrialized countries are an order of magnitude larger than emerging markets. And emerging markets, conversely, in terms of trade, has a larger share of GDP than a lot of industrialized countries. So the way I would characterize it when we talk about globalization is that these developing countries are much lower on the scale in terms of financial globalization relative to trade. But the pros and cons, you know, it's arguable.
I'm going to start with a overly simplistic concept here, and that is that some of you may have heard this before, that one key difference between communism and capitalism is the role of prices. Prices doing the adjustment for the market. So we all learn from Econ 101 that there's a quantity line and there's a price line, and you have a demand curve, you have a supply curve, and price does the market clearing for the market. In the case of China, there are three most important prices that have until now not been allowed to help the markets clear. One is the price of money, interest rates. Two is the price of the currency, the exchange rate. Three is the price of energy goods. Now the prices of energy goods have been liberalized recently, but not the prices of the first two. So when we talk about financial liberalization, for me, it's a decision made by Beijing recently to allow prices to do the adjustment process for the money market as well as the currency market. And therefore, in practical terms, financial liberalization entails two main components. One is to liberalize the interest rate markets in China, and two is to open the capital account. And there are a lot of challenges and technical difficulties involved in this process, which we will talk about. But essentially, this I suggest is one framework in which we can think about this issue.
Being the last commenter on this topic, I have the advantage of saying that I agree with them all. And in addition to that, I think one very China unique characteristic on the liberalization of the financial market is the patron itself, i.e. the banks, the insurance companies, and the financial non-banking financial institutions, whether they would be allowed to liberalize themselves, whether there would be any sort of loosen of the licensing permits of establishing new banks, for instance, which we have seen that has been sort of experimented in the Shanghai Free Trade Zone, and also as to the entities that would be entitled to taking deposit and lending money to the public. For instance, the China banking law actually says only the banks and the government-regulated non-banking financial institutions would be allowed to take deposit and lend money to the public. If you are a company, for instance, you have extra cash flow, you are not allowed to lend money to another company, but you have to do that through, quote-unquote, entrustment loan through a bank, which is not a way to do the business. So the liberalization of the financial market, I would say, to include the patron of that particular important element.
Thanks. Professor Chen, I'd like to go back to you on your point about historical experience. I mean, do you think that right now China needs to liberalize? Is it out of necessity, or is it simple and natural progression? Because there's been the argument that China has hit a growth bottleneck, investment growth running at 20% year on year is becoming too costly, and the returns to growth are very, very low right now. So is the party being forced to do this, and is this the right time? And Stephen, do you think that the market is playing its own role to push China in this direction as well?
Well, so we all know that labor costs are rising in China. So my stance is to sustain the growth, to push China towards a global frontier. It has to move away from the cheap labor model to a cheap capital model. Now, let me warn you that the returns to capital, returns to equity on the firm side is very badly measured. I wouldn't trust any of the data. It's not about data supplied by the Chinese government. It's about measurement. That's grossly mismeasured. I believe that there are really high returns to capital and equity in many of these firms, depending on which firms you measure and whether you can actually find the data for that. So what I want to draw is a historical experience. This is not the first wave of globalization. Arguably, it is the first wave of globalization where emerging markets and developing countries are a very important part of the game role. In the 19th century, there was a first wave of globalization, and Great Britain had amassed a huge amount of external wealth, large current account surpluses, which was invested in emerging markets of that time, in Argentina, Latin America, and so on and so forth. The US had a similar experience of amassing a huge amount of external wealth, current account surplus, for a long time, right before the First World War. And Japan has had a huge current account surplus and never looked back since 1960. So China is obviously having a large current account surplus that's extended for many years. But the experience of these economies were very different, and I think we can, in this instance, draw from the historical experience. In that, the UK and the US, what they did with their huge amount of external wealth and large current account surplus is to internationalize their currency, internationalize their financial markets, make the stock exchanges in each country international global financial center, which is very much in contrast to the experience of Japan, which kind of did the opposite. Not did the opposite, but it did not use that experience to really internationalize the currency and build a truly global financial center. So it's a golden opportunity, in my view, for China to take advantage of that large external wealth, still in a stage of development, to internationalize the currency and build a great financial center. So otherwise, we could potentially have the experience of Japan of all the capital bottled inside, which created a bubble, and subsequently it's bursting. So I think we can, in particular, draw on that experience.
Stephen?
So on your question on whether or not the timing is right, I don't think it's right. It should have been done in 2005. When the renminbi was initially floated, that process should have begun then, in my opinion. In fact, we had talked to the officials about this. It's a little late, and my fear is that because Beijing is starting the process late, they might be under some pressure to do this quickly, almost too quickly. That's really my concern. Of the two components of reforms that I suggested, interest rate liberalization and capital account liberalization, in my personal opinion, the former is more important. We need to get the former right first before one should open up the capital account. Because I think exchange rates in the world are most of the time out of the equilibrium anyway. So getting the exchange rate right, to me, is not as critical as getting the domestic interest rates right. Once you have the yield curve in China that is economically meaningful, then you can talk about liberalizing the capital account. Lending rates in China, as most of you know, have been around 6% for many years. Before the financial crisis, nominal GDP was growing at 15%. Now, nominal GDP may grow at 10% or so. 7.5% for real, 2.5%, 3% inflation. That gives you 10% inflation, or nominal GDP. But the lending rate is still 6%. This is not a market clearing rate, which means that when you have an interest rate that is substantially below the normal rate of return on your investment, you're going to experience excess investment. And number one, so number two, and of course that's what we're seeing. Number two, credit rationing. Banks will be incentivized to allocate credit to their preferred customers, like the state-owned enterprises. And this is why we're seeing that it's the state-owned enterprises that are over-investing. The private sector entities, as was said earlier, actually are able to generate good returns. So you have segmented markets, and number three, the third implication of the fact that we have segmented market is that you have the black market or the unofficial market, shadow banking system. This came about because there's an intrinsic demand for credit at the official lending rate of 6%. It's just not high enough. So we need to get the interest rate at the right level, build a meaningful yield curve, then we can talk about the next steps of making the renminbi a dominant international currency or a reserve currency.
Mr. Zhang and Mr. Wells, do you, in your interactions with Chinese counterparts and officials, do you think there's a rush to liberalize right now without thinking things through? Do you think that there are certain institutional reforms which need to take place first?
I definitely think there is an imperative to move forward. Yes, I think though there is probably a greater recognition of the kind of mispricing of credit. The question is, how do you get from where you are, where China is, to where it wants to be? And that's where I think, that's where there are some difficult problems ahead. There are some, impaired loans. There are some unperforming sectors. There are local authorities that have borrowed money, building things in the hope that people will come, and they haven't. So not everything has worked, and not everything's been successful. This is why I think that there is now a real opportunity for developed markets and financial institutions to engage, and perhaps through greater participation in the onshore markets to raise the bar, so to speak, and to get to a better and more accurate allocation of resources and a better pricing of risk.
Mr. Zhang, what do you think the imperative is at the upcoming third plenum of the 18th Congress? Where do you think that they will really just bite the bullet and strike first?
That's going to be a very big forecast, and I don't think I would be possibly to do the right. But on the timing of the convertibility of IMB, I actually fully agree with you that the 3-year experimental period for the Shanghai Free Trade Zone would be the deadline to roll out a nationwide fully convertibility of IMB. And the deadline, the latest deadline I would see, if I read correctly on the State Council approval back to the Shanghai 5-year plan back in 2012, it says that Shanghai by 2020 should establish itself as an international financial center compatible to the China standing in the global market, i.e. That by 2020, that would be the latest deadline to sort of allow IMB to be freely tradable.
I want to continue on the theme of the Shanghai Free Trade Zone here, because a few people actually see it as a Trojan horse for capital account liberalization, and actually allow outflows, especially retail outflows from China, and this could be really destabilizing. Do you and all the other panelists, do you think that this is a risk? And maybe even when setting up the free trade zone, that aspect should be the last piece of the puzzle and not be tried until China is truly ready?
Well, as I said, I think in my remarks, this is an experiment. It's quite small in the sense of being in the zone. It's actually quite a small zone. Will its freedoms extend beyond the zone? Well, that's the bit I don't think we know yet. Will there be a rush of money exiting China? There will be some, I'm sure. But I don't think we know enough about the detail, and we don't know how this experiment is going to work in practice. Ask us again in 6 months' time, we might have a better idea, but at the moment, I don't think I can answer that.
Well, if I can offer my view as a practitioner who is a lawyer, I always read the context very carefully. I read the Shanghai Free Trade Zone, sort of the official reply very carefully, and I think what you have concerned may not be that important for two reasons. Number one, in many of the places, the government always inserted whenever the risk is controllable. In Chinese, 当风险可控的时候, whenever the risk is controllable, i.e. the government would not let freely go the fully convertibility and outflow of the currency. And secondly, there have been many other similar experiments on the issues. What the Chinese government would like to do is to set up special account-based supervision administration. And also, they would like to put a quota above that. So if you have the special account monetarized sort of supervision, and in the meantime, you put a quota or above, which means that the risk is fully controllable. That's my reading.
But if it's subject to risk, then doesn't that put a dent in the very concept of liberalization? Because if we actually believe in Mr. Market, then you should assume that the market should be able to factor in that risks without artificial control. So, Dr. Jin.
No, actually, I just want to take a step back and be just a little bit provocative here and play the devil's advocate. Why do we think that China is necessarily ready? Okay, and not necessarily that I agree with this point, but let's contrast the experience with Latin American economies. What China has been asked to do in terms of change, reforms, is really embracing the very embodiment of Latin American policies and some of its problems. So for instance, China has a really high savings rate. People say bring that down. Latin America has a huge consumption, consumption-driven economy, really low savings rate. China is asked to liberalize its capital account. Latin America has very, very good financial liberalization compared to trade liberalization. Sudden stop of capital inflows has brought about, sovereign debt crises, banking crises, and currency crises in Latin America. It's defined their era. Exchange rate convertibility, all of that is very much part of the Latin American phenomenon rather than the East Asian experience. And huge current account deficits in Latin America compared to current account surpluses in China. So it's exactly the polar opposite of the emerging market experience. And funnily enough, the reasons for which Latin America is criticized for its policies is exactly the policies that China is asked to embrace. So my own view is that there's something other, something more fundamental about the economies that's not through the forms in which these liberalization take that make Latin American potentially much more riskier economies than China is. That's my own view. It's only a prima facie evidence of something that's more fundamental than these liberalization policies. But I just want to, as a macroeconomist, bring us to the macro level. Why do we think, I think we're in agreement, that China is really ready for that, and what makes it really different from Latin American countries?
Stephen, as a macro trader, you lived through the Latin American crises. Are you more concerned about China at this point than, say, Brazil or Mexico were at the beginning of the 1990s, or Argentina in the early 2000s?
Well, I actually share the concerns. I think China should liberalize the capital account only when the domestic financial markets are ready, and they're not ready. And that's why I suggested earlier on about the importance of sequencing correctly the two reforms. I have one footnote to add, really small point to add. This is about your point about capital outflows. We did some calculation, simple calculation, comparing China today, its holdings of foreign assets in percent of GDP, versus Korea 15 years ago and Japan 30 years ago. What we see is that in terms of the amount of foreign asset holdings, China is about at the same point as Korea was half a generation ago and Japan was 30 years ago. The big difference is that most of the foreign assets China has are held by the central bank. The central bank has $3.7 trillion US, and that accounts for almost all the foreign asset holdings of the nation. So our fear is that if and when the capital account is liberalized, there will be a huge outflow, a huge demand, as you suggested, by the private sector entities. So the central bank will need to make a decision. Do they let the outflows happen and drive dollar renminbi up, or do they sell their reserves into the market and to satiate this demand for US dollars? And if they do the latter, then one can rationalize the huge, almost irrational accumulation of official reserves as a form of pre-funding of the future private sector capital outflows. So I think that's an important consideration. China's private sector will demand a huge amount of foreign assets. It's coming, it's a tsunami. And the question is, how do the policymakers control the pace of the outflows?
I've just been told there's 5 minutes left before we move on to Q&A, but I'd like to leave the floor open for Q&A as long as possible. So I've got one final question for each of our panelists, and this is in the context of CMI internationalization. So the latest Bank of International Settlements triennial currency report notes that the CNY is now the 9th most traded currency in the world right now, but it only has 1.1% of the market share of global FX markets. Contrast this with the US dollar at 43.5%. So I'd like each of you to make a forecast in 6 years' times, or in 2016, 2017. Where do you think CNY will rank from number 9 as CNY is right now?
Wow, that's. I think if I knew the answer to that, I would be able to retire. I think you know, if you look at the current structure of the FX market, there's the dollar leg, and that we're starting to see that gradually being removed. So, you know, if you want to buy rand and you're in Singapore, you go through the US dollar. That dollar leg, as I say, is starting to diminish. So we will see the US dollar share of FX markets go down, and more direct quotes. So we're beginning to offer direct quotes between CNY and GB pounds, for example. There will be more direct quotes. There will be less dollar trading. RMB will rise. Where it will rise to, I'm not sure I can give a number.
I hate forecasts. I never read forecasts, so I don't know why I would be making them, but if I were forced to do so, and I am currently, I would say that the ranking won't change by too much, and I don't foresee a huge change. It's, you know, again, it's relative, right? So if the dollar is going to reduce proportionally, then it's possible to go up. But in any case, I think one thing that people have to be clear of, if you look at the PPP GDP income in China between 2006 and 2009, you think at 9% growth they will be moving up the ranks, right? It actually had fallen, okay, PPP ranking in terms of, you know, falling a few ranks down. So I think it's going to stabilize. That's my sense. No big change.
I don't mind making really long-term forecasts because most people will have forgotten what I've said here. So by then, I happen to have some of the numbers that Jeff mentioned. So China is, in terms of its international share of currency usage, it ranks behind Mexican peso now, ahead of New Zealand dollar. So I would guess China will rise in the rankings pretty sharply. The number one currency in the world is the dollar. Number 2 is the euro, accounting for 17% of the total. Number 3 and number 4 are very close, Japanese yen and sterling at 12%. I think China will beat these two currencies and become the number 3 international currency in the world. One last comment, if I may. Be very careful thinking about trade. Don't confuse trade settlement. I know there's a lot of news about China signing agreements with neighboring countries to settle trade in renminbi or the other counter currency. That's not that important. The data that was cited earlier, if you calculate the percent of the total FX transactions that are associated with trade settlement, it accounts for less than 2%, which means that for every dollar that's traded in the currency markets, there are $50 that are traded that are unrelated to trade. They're related to capital flows. So for the renminbi to really become an international currency, a size that corresponds to its economy in the world, then China will need to develop the capital markets quite a bit between now and then in order for the renminbi to be a viable and interesting and meaningful capital account currency, not just for trade purposes.
Floor is open. Anyone with questions, please? Please, the lady in the middle.
Hello, it's Liamen from Bloomberg. And I would like to ask about what's the actions the financial institutions are currently doing to react to these changes or the future prospects. And I think that one is general other financial institutions, and secondly is about the Chinese banks. How would you say they will perform in London? Thank you.
Well, I think so the Chinese banks in London are still relatively small, but they're growing and they're developing their business. And with the change of regulatory structure announced by the Chancellor, although it wasn't actually a direct announcement of a change, it was an announcement of the potential for a change, we could see those banks, if they are operating as branches, we could see them growing significantly. Sorry, what was the first one? What are institutions doing? I think certainly the institutional investors in London are looking at the potential for schemes like RQFI and to see how they access it and what that offers and how they would go about developing you know, an investment strategy on onshore. Firms that have in the past either had limited exposure or no exposure will be looking to increase their exposure to the Chinese economy, I'm pretty sure.
Mr. Zhang, in your dealings on the legal side with Chinese institutions, are you seeing a shift in towards being more active here and how they're responding?
Well, I guess the Chinese banks and the financial institutions are trying to catch up, and most important for them is to sort of launch more market-oriented products, because historically they are getting accustomed to taking deposit and lend money, and by taking the margin, that would be a huge profit for them. I recall that the 4 banks just announced their quarterly performance, and ICBC would earn almost 20 billion a day as profit.
Please, the lady in the middle.
Good morning, everyone. I'm Zhang Huan from London Business School. I have a question for all panelists. So usually China's economy is dominated by state-owned companies. But recently we have seen more and more private companies participating in these state-owned companies, maybe minority investment or something else. So do you see this is also part of the China's economic liberalization, and what's the pros and cons in this trend? Thank you.
I'll start with that. So, yeah, the share of state-owned companies as a share of GDP has certainly been declining with the private sector rising. That's not surprising. What is surprising is the productivity level of state-owned enterprises has been rising. And that I find really, really interesting. I think part of the reason is the massive labor layoffs that made, you know, and actually the companies more efficient over time. So I would be very careful in saying that all state-owned companies are, you know, inefficient, or they do have access to great investment opportunities. That's kind of one of the inequities about the Chinese economies. But for that reason, they're also making huge profits, and labor productivity is rising. So the last point I want to make is that the total factor productivity, which is just productivity growth in China, has been the main drivers of growth in the recent 5 years, not so much capital accumulation. And part of that is still the declining share of the state-owned companies. I mentioned that state-owned companies' productivity is going up, but still the private sector is more efficient. So when you reallocate resources away from state-owned companies to the private sectors, that reallocation of resources has been one of the key drivers of recent Chinese growth, and I foresee that continuing in the next 5 years.
Stephen?
Yeah, I fully agree with that. I would just add that right now the state-owned enterprises are still enjoying a lot of monopolistic market treatment and concessions given by the government. So as a part of the market liberalization, I assume that some of these preferential treatments will be normalized, will be removed, and that should allow all firms to have a more level playing field. The other minor point I'd like to make is that, yes, indeed, there has been an acceleration in total factor productivity growth, and the contribution from capital deepening has not been as much as before. However, I came across a very interesting chart, and I'm sure you can get this from the Penn data set. That's quite extraordinary. It shows the US total factor productivity growth over the years, and Chinese total productivity growth over the years. And you can see that the cumulative progress that has been made by China at the same levels of per capita income has been about a third of that of the US, 1/3. So we can talk about what China needs to do to be better tomorrow compared to what it's doing today and yesterday. But another comparison is how much better can China do compared to the United States, setting aside the issue of cheap labor and abundance of the labor supply. So if we talk about the quality of investment, I'm afraid to report that the quality is still quite low in China, and China is still in the imitation mode rather than the innovation mode. And we need to somehow, at some point, make that switch. And all these steps are moving in that direction, but I'm just suggesting a framework in thinking about this.
Just have one minor comment on the sort of the state-owned enterprises and liberalization to the public sector. I think that trend would possibly come very soon partially because of the way to resolve the local debt issue. The local government has accumulated substantial debt where they have been sort of trying to get rid of. They used to get rid of that through selling the land use right, and get the land grant fee. That may not be a long-term sustainable thing, and I would anticipate that the government is trying to get rid of partially non-core state-owned assets in order to address the local debt issue.
Mr. Wells, and final comment, and I'd also like to ask you, when you interact with the big five banks, the big four banks in China, do you think that in China you're on a level playing field? Do you think you're on a level playing field even outside of China right now?
Wow, that's, I mean, I think one of the things that maybe the Chinese authorities need to consider going forward is exactly what is the role of the foreign financial institutions. And I would include the Hong Kong and Shanghai Banking Corporation as a foreign institution for these purposes, although we've been there for a long time. I think they do need to think about what is the role of those institutions going forward. In terms of, in Europe, as I say, the Chinese banks are still relatively small, but they're building their businesses actively. And I think that, once they can, or if they can, for wholesale business, certainly, use their Chinese balance sheets, then they will be a force to be reckoned with in Western European centres, definitely.
Okay, and I think that's it for today, I'm afraid. I'd like to thank our panelists, Mr. Ed Wells of HSBC, Stephen Jen of SLJ, Dr. Jin of the LSE, and Mr. Zhang Yi of King Wood Mallesons. Thank you very much, and thank you for our audience.